Saurabh
Recording in progress.
Formally, to our webinar. Thanks a lot, Saurabh, for gracing this occasion. Thanks a lot to all the participants who are here. And we have Shri Saurabh Soparkar, who's a very well-known senior tax counsel. Saurabh is one of the best tax brains in the whole country. We have immensely benefited from his knowledge, and we continue to learn a lot from Saurabh. Saurabh, deals not just in tax matters, but equally in non-tax matters. And, Saurabh regularly appears at Supreme Court, High Court, Tribunal, etc. So that's a small introduction of Saurabh. The way we will construct our, webinar today is, Saurabh is our keynote speaker. We'll have some, high-level comments from Saurabh on how he has, seen the budget, tax proposals, etc. After that, we will jump into the direct tax and indirect tax proposals. I have my, partner Rutul Shah with me, who will touch upon certain aspects of direct tax proposals, and the balanced direct tax proposals will be taken up by me. And then Chintan would take up the GST proposal. We have a Q&A tab, on the Zoom. So, do put your, questions on the Q&A tab. And maybe at the end of the session, we would try to address, some of your questions. With this, I once again welcome Saurabh. Saurabh, the floor is yours. We are keen to hear you, sir.
Thank you, Vishal. It's a pleasure to be here to give a very broad overview of the budget for the current year. I believe the Honorable Finance Minister had an unenviable task. The country has been under the corona effect since last 2 years. Significant part of government revenue has been spent and is still required to be spent both for the purpose of vaccination and for the purpose of treatment. There is therefore a strain on the government funds. The ability of the people to shell out more money by way of taxes obviously is also to a great extent impacted. Government needs money, but the government would not find avenues to raise the money. Under the circumstances, I would say the Honorable Finance Minister has done a nice balancing work. She has not resorted to any additional levies. There was a rumor, a strong rumor of reintroduction of, for example, estate duty law, Wealth Tax Act. There were suggestions from a few bodies saying that rich people must be taxed because they have ability to pay more amount of taxes. The Honorable Finance Minister has not gone by that populist socialist move, because the moment you start taxing people beyond a particular level, it's counterproductive, and Honorable Finance Minister has recognized this. And therefore, what has been done in this budget? Before I really go there, a quick look at the economic indicators. During the financial year 2021-22, it is expected that the economy will grow at 9.2%. And in the financial year 22-23, it's expected to grow at around 8.5%. We are also expected to spend significant sum of money, as I said, for vaccine coverage. And there are also issues of severe infection, supply side disruptions, weak labor market, and inflation remains the key concerns. Under these circumstances, when the Honorable Finance Minister presented the budget, we were all looking forward to her budget speech to find out nuances of what she proposes to offer. While the budget speech itself was brief, there are several changes in the finance bill covering a wide issues ranging from taxation of crypto assets to extensions of tax holidays, changes in the custom framework, as well as procedural nature. There are several policy announcements. including those facilitating accelerated corporate exits, replacement of special economic zone, and boosting private equity investments. On the tax front, barring rationalization of the rates of surcharge applicable to AOPs and to income in the nature of capital gain, there have been no changes. There is a minor relief in relation to the compensation or funding on account of the infection of COVID. There are few things here or there, some of them I will touch, but there are areas which budget did not even address. For example, there is no mention of any roadmap towards implementation of, in India, of the global base erosion and profit shifting BEPS 2.0 proposals. Similarly, widely expected clarification relating to equalization levy and framework for overseas listing by Indian corporates did not materialize. With this, let me go very briefly to some of the proposals in the field of direct taxes. As we said, the rates slabs have all remained unchanged. There is one new area of taxation, and that is in the field of taxation of virtual digital assets. This has always been a subject matter of serious debate. Cryptocurrencies, whether it should be legalized, should not be legalized. Probably government is picking up a middle path of regularized observance of that field rather than declaring it to be illegal. And now the proposal is to tax all transactions in relation to virtual digital assets at 30%. 30% after giving deduction of expenditure incurred to acquire that asset, but no set-off of loss from transfer of these assets against any other income. No carry forward of losses to be allowed, meaning thereby, if you earn income, pay tax. If you suffer loss, God may help you. You will not be able to set off against your other income, nor you will be able to carry it forward for deduction in a future year. Last year, there was an amendment for the purpose of taxing corporate entities at a concessional rate if you are manufacturing or producing goods or articles. The extension has been granted, and so long as you start the activity by 31st of March 2024, you will now get the amendment, you will now get the deduction. In relation to business expenditure, with which most of you are concerned, there are 2-3 proposals. One, on account of couple of judgments, the education cess has been held to be allowable as business expenditure. It is an avowed policy of this government not to bring in any retrospective amendment. However, in a marked departure from this avowed policy, law is now sought to be retrospectively amended from assessment of 2005-6, and no company will be entitled, or no SSC will be entitled to claim educational cess and as an expenditure in computing the business income. This would put at rest the spate of litigation which had started on account of this. Left to me, I always thought that expenditure was not otherwise allowable. One amendment which is likely to create a complication, especially in pharma sector, is the proposal is that if expenditure results into income in the hand of the recipient, which under the respective legislation is not permissible to be received by him, then expenditure would not be allowed as a deduction in the hand of the payer. Now, so far as payer is concerned, ordinarily he is concerned with his own law. He is concerned with as to whether or not what he makes, what he pays is within 4 corners of law with which he is concerned. The government never wanted pharma companies to claim deduction of incentives interrelated to doctors or pharma family to be allowed as a business expenditure. However, the view that was taken by the tribunals was that so far as pharma company is concerned, there is no prohibition. If there is a prohibition, it is under the medical council recommendation, it applies to doctors, and therefore, why should pharma company not get the deduction? Now the law is being amended, and in all those cases, deduction would not be allowed. All of us are aware that in relation to exempt income, expenditure is not to be allowed. There is a proposal now because there was a school of thought accepted by various courts that if there is no exempt income, the question of disallowance of expenditure will not arise because expenditure will be disallowed only if I have an exempt income. Now the law is sought to be amended whereby if you don't have an exempt income, the expenditure itself will not be allowed to you. One major issue which I believe is going to create far more complication is if I borrow money under section 68, I need to show that the person that I have been able to show the source of my funding. Therefore, I have to show from where did I get the money. From where the person who gave me the money is not something with which I am concerned. To this, there was an exception in the matter of the issuance of share capital. Because, and let's be very frank, huge frauds through Kolkata companies have been committed, whereby by having layers of companies in between, cash or unaccounted income was sought to be made legitimate sum of money. However, it was so far restricted to only share capital. Now, ordinary loan will have to suffer this kind of rigorous proof to be provided by the SSC. Therefore, if I borrow money, let's say rupees 10 lakh from Mr. X, in order to ensure that I don't end up having income added in my hand under section 68, which is 60% plus surcharge, etc., which is essentially almost 78%. So far, I was required to show that Mr. A had capacity to pay and from where he got the money. Now I will have to prove and show not only my source, I will have to show source of a source, meaning thereby from where A got money and whether the person who has given money to A had ability and capacity to make payment also will have to be proved by me. In a large number of cases, by the time inquiry is started by the income tax department, it is likely that I would have paid back the loan. It is likely, therefore, the creditor may have no reason then to be in contact with me. In such a situation, if I were to call upon creditor to be cooperative, he might as well say, why should I bother? And therefore, this is going to create complication. We had dividend stripping. Now, bonus stripping is extended to securities also, which is likely to create some issues in the matter of planning. Faceless assessments had been a matter of contention. I do not want to go into greater detail, but one fundamental amendment which is to the benefit of SSC that is proposed is that if you ask for personal hearing, then the department shall grant personal hearing. It's not a matter of option. The assessing officers were taking a position, I may grant personal hearing, which was leaving a very bad taste in the mouth of the SSCs because they were feeling that without hearing us, the orders are being passed. There are some proposals in the matter of repetitive appeals which are sought to be reduced at the end of the department. In substance, I am sure you are anxiously waiting Vishal and his team to give far more greater details. In substance, this is a budget which may not have disappointed, at the same time has not made people extremely happy. There was a belief that this is not election year of the parliament, but it's the election year of state legislatures, important state legislatures, including UP, and therefore there is going to be many more concessions. In a way, as a citizen, I am happy that the Honorable Finance Minister has not succumbed to that populist move. And probably, under the circumstances, she might not have been able to do better also. With this, let me end my preliminary view. I would now hand over to Vishal Bhai for far more detailed and intense talk. Thank you very much.
Many thanks. Very well summarized, and as you rightly said, it's not a bad budget at all, while it might not be a very good budget. Yes, I completely agree. The expectation was with the elections around, the government might actually make it a very populist budget, but there seems to be a strong political equity which the government believes in. So I think with that, what we will do is we will jump into the dissection of the budget proposals, and we'll start with my co-partner Rutul. Rutul, I would load the presentation. Sure. And you do guide me when you want to move to a different slide.
Yeah, sure. Yeah. Anyway, so what we'll do is I'll briefly cover economic analysis, more to do with statistical numbers and analysis. We'll then go to regulatory proposals, tax rates, and personal taxation. This is what I intend to cover. India is a 3 trillion economy, and when a 3 trillion economy comes up with a budget, the whole world watches that. And I think with that, we are going to have very interesting discussion over next 80-90 minutes. The economic, the GDP growth, we of course spoke about that. I think the most important aspect about economy today is consumption, investments, and I think consumption is going at a decent rate. With the growing consumption, the government has also been able to maintain a balance of investments, regular inflow of investments, growing investments. We are seeing record number of demat accounts opening in capital market, and people making good amount of investments in markets, debt market, mutual market, equity market, etc. At the same time, the government has also been able to maintain inflation. That's also remained under control, under check. Second wave impacted the economy pretty badly, but the government again could salvage and could sustain the economic development and growth in the third wave, and I think we are seeing those numbers. In terms of numbers, I think we are also looking record collections in GST. We are continuously crossing 1 lakh crore on a month-on-month basis. Corporate tax collections have also been decent. Revenue receipts are up. We are the gross revenues have grown more than 50% on year-on-year terms. 90% growth in corporate tax. We've also seen expansion in the number of returns filed, the assessees, etc. So I think all in all, these are all indicators of a growing economy, indicators of a mature economy which is maturing and moving to a paradigm shift. The capital expenditure again have grown. Our GST collections have already reached 60% of the budget estimate. So I think we are talking of good statistical performance, good statistical numbers in terms of economic performance. And these are all good indicators of a positive economy. Forex numbers have also looked decent. We are looking at $600+ billion of forex reserve, which is equivalent of 13 months of imports. We are now the fourth largest economy in terms of forex reserve, only after China, Japan, and Switzerland. And in terms of sector-wise performance, I think our agriculture sector, India has always been predominantly an agriculture economy, and agriculture sector has never failed to perform and has never failed to demonstrate performance. Industrial sector has also been doing good, and there are quite a few incentives, production-linked incentives, incentives under Income Tax Act. So industrial sector has also been on good track. Service sector is something that India has been contributing significantly to India's GDP, and I think there is a room for government to take certain measures on the policy side. I think we should continue doing better on the policy, on the service side as well. With that, I'll move to the regulatory proposals. Coming to the Gift City, I think Gift City has always been pet project of our dear Prime Minister, and ever since he was the Chief Minister and he conceived this whole idea of Gift City, he's been continuously focusing on Gift City, and efforts from state and center have always been to sort of give impetus to Gift City and make it a world-class financial services center. And what it was a decade before, a 5 year before, and what it is today, I think we are seeing remarkable development on Gift City side. One important announcement on Gift City side today is announcement for foreign universities and institutions to be permitted in Gift City to offer courses in financial management, fintech. I think this is a very, very welcome move. We've seen a lot of Ivy League universities operating out of the second campus, as we call them, from Singapore and Dubai. I think Gift City, if it enables such foreign universities of great repute to come and set up presence, I think that will be a great move for India. International Arbitration Center again is an important move which is allowed to be set up in Gift City for settlement of disputes, because earlier we used to see arbitration matters moving to Singapore or London. I think with this, we could see a lot of international arbitration matters coming to Gift City. Global capital and sustainable for sustainable and climate finance is also to be facilitated. So that's again an important move. One important measure by government is on voluntary winding up of companies. Today, when we look at winding up process, it's a very, very cumbersome, compliance-driven and tedious and time-drawn process. Of course, we always had the easy exit scheme available, but I think this proposal of bringing Center for Processing accelerated corporate exit CPACE, as they call it, with process reengineering, will aim at voluntary liquidation period to come down to 6 months. So I think that's also a welcome move. Cross-border insolvency, again, IBC, after IBC provisions were introduced, government has not really done much on timely resolution of insolvency process. While there have always been talks about doing something on IBC to make it more robust, make it time bound, and resulting into quicker resolution is something that we must see on the IBC side. One important announcement is to enhance the efficacy of resolution process and to facilitate cross-border insolvency resolution. So that's again a welcome move. We've seen tremendous importance being given to data centers, energy solutions, overall infrastructure, and with a proposal of bringing data centers and energy storage system to harmonize list of infrastructure for credit facilitation is again a welcome move. An expert committee is also is proposed to be set up for overall review of regulatory framework, and also to see if there is any overlap or is there a gap between regulatory provisions for venture capital and private equity, so that we have a holistic situation dealing with both these players, which are very important pillars of the equity market. And lastly, again, very interesting, we'll have Vishal talking about virtual currencies later, but I think the government does realize the importance of digital currency, and that's where there is a proposal of RBI bringing a digital currency in the form of digital rupee. So using, of course, the same blockchain technology. So that's again a welcome move. Of course, we'll have to see what regulatory framework the government creates for that. With that, coming to tax rates, I think tax rates broadly, there is no change on the tax rates. One very, very important move is on surcharge, where surcharge on long-term capital gains other than the long-term capital gains on the listed securities is capped at 15%, which effectively means that the peak tax rate on sale of long-term capital asset, being unlisted shares of private limited companies, closely held companies, and other immovable properties, would come down from 28.5% to 23.92%. For non-residents, of course, the rate of tax was lower. It was a 10% rate, but there again, with surcharge, which earlier was 14.25%, would now come down to 11.96%. This is a very, very welcome move, because we've seen a lot of transactions on private side, and that's where the long-term capital gain was turning out to be a huge burden, and 4.5% of reduction on the domestic side, resident side, and almost 3% on the non-resident side is a significant move and would result into significant savings for the sellers participating in transactions. AOP, again, surcharge is proposed to be kept at 15% because a lot of consortiums for works contract, international contracts, have a requirement of forming an AOP, and that's where, by virtue of setting up an AOP, the surcharge used to shoot up at 37%, the peak rate. Now, regardless of the fact whether all the participants and constituents of that AOP were companies or not. So in order to bring the AOP comprised of all companies at par with a company which is taxed at a rate with a surcharge capped at 15%, the AOPs comprised of all companies is also proposed to be brought down to 15% in terms of surcharge. AMT on cooperative societies is proposed to be reduced to 15%, and even the surcharge is proposed to be rationalized at 7%, up to an income of 10 crores. Personal taxation, I think this is more in line with circular issued in June 21, more to give relief on the COVID impacted people, whether it is salary income given to employees for their own medical treatment or medical treatment of employees. There is a relief from that not being regarded as perquisite, so there's no maximum threshold as well. Even when a person receives any relief from people other than employers, there is a relief granted under section 56 where such relief will not be regarded as a taxable income. Of course, the condition on the amount being received within 12 months if person is no more. These provisions are a welcome move for all COVID impacted people. Of course, this is subject to a detailed guideline to be prescribed by government. With that, I hand over to Vishal. Vishal, over to you. I'll stop sharing the presentation.
Yeah, thanks a lot, Rutul. Let me share the presentation. I hope the presentation is legible. Great. I think the first topic I would like to take is about this whole taxation of cryptocurrencies, which I think has created a lot of interest. There were two issues about taxation of any cryptocurrency. One is, the characterization of the income. Is it a capital asset? Is it a business asset? Would you like tax on any other, income from other sources, etc.? And the government has finally, kind of brought a separate code of tax under the Income Tax Act. The second issue on the GST still remains, I would say, untouched. So we'll have to wait and watch for the GST Council, whether it is coming up with any clarification, any rate of tax, etc. So let's quickly jump into what the Income Tax Act has, brought about. So first, the government has defined cryptocurrencies under a basket, which they are naming it as virtual digital asset, which includes cryptocurrencies like Bitcoins, etc. It also includes non-fungible tokens, the NFTs, which are becoming popular. It's more a form of digital art, which needs to be kind of, held by various customers. And the definition also says that the government has the power to notify other assets. Once a certain asset falls under the definition of VDA, which is virtual digital asset, then there is a separate tax rate section introduced, 115 capital BBH. It says that any income you generate from the transfer of that asset, it would be taxable at a flat 30% plus applicable surcharge and cess. Which means, if you are an individual, your tax rate could be taxed at the highest rate of, 43%, because your surcharge could be 37%, etc. The manner in which you will compute your taxable income is by reducing the cost of acquisition from the sale consideration, and you will not get any other expenditure, as an allowable expenditure. You will only get your cost of acquisition as an allowable expenditure. No brokerage fees, no other expenses. And very interestingly, as Saurabh said, the manner in which they have drafted, if I incur a loss on a trade, that loss is gone forever. I don't get any deduction. I don't get any set off, and I can't even carry forward that loss. So this is going to lead to a very peculiar scenario. Let's look at, I sell Bitcoin, let's say today, I earn a gain. I'll pay a tax of 30% plus surcharge plus cess. I again trade into Bitcoin tomorrow and I incur a loss. Sorry, that loss is not available. It is just a sunk expenditure. Now, is it the intention of the government that they do not want to allow any kind of a loss? I think we'll come to know when this finance bill is legislated into a finance act. But I think prima facie, the provisions look to be very, very harsh in that case. There is another issue in this taxation of virtual digital asset, the manner in which they have defined a virtual digital asset. Somebody can say even a demat share gets covered. I don't think that's the intention. I think the government will come back and clarify that we do not intend to include any demat, shares, etc. But the definition seems to be pretty wide, and I think the government will have to kind of tighten the definition of a virtual digital asset to ensure that it is only including cryptocurrencies or NFTs and not any other kind of a digital asset. Today, when you give a gift of shares other than to a relative, it is taxable under Section 56. You give a gift of gold, it is taxable under Section 56. And Section 56 includes a finite list of items which are subject to what we call a deemed gift tax under Section 56 of the Income Tax Act. What is a cryptocurrency? Is a cryptocurrency a security? Is a cryptocurrency some kind of a cash? Answer is it might not be any of it. And therefore, the government realized that they might not be able to tax any gift of cryptocurrencies given by one person to another person. So they have finally amended the list of properties covered under 56. And now if you give any gift of a virtual digital asset, subject to that gift not being given to a relative, such a gift would now be taxable from the next financial year. One very interesting provision they have brought in is regarding TDS. And what they are saying is that when there is any sale, by a resident person to any other person, then the buyer has to basically deduct a TDS of 1%. And they have given certain categories. So let us say the buyer is an individual or an HUF, but the turnover from the business is less than 1 crore and the turnover from the profession is less than 50 lakhs. And the total aggregate consideration which it is paying in that trade is less than 50,000. In such a case, there is no TDS required. Similarly, if there is any other person paying the consideration, let us say a partnership firm or an LLP or a company is buying Bitcoin from a resident person and the total trade value is less than 10,000, then there is no TDS required. The way they have defined this aggregate consideration, they are saying aggregate consideration in a financial year, which would mean that if I'm buying from the same individual and my limits crosses 50,000, if I'm an individual or an HUF, or if my limit crosses 10,000, if I'm, let's say, a partnership firm or a LLP or a company, then I have to deduct the TDS. The question which arises is how will they apply this? Because most of these Bitcoins are being bought and sold over the stock exchange, So many times you do not even know finally who is the seller and whether it's the same seller who is selling again and again to you. So this is going to be, I would say, a bit of an administrative challenge. So we'll see some further clarity coming from the government. I think with that, we move to certain provisions of the corporate tax. The first provision is what Saurabh briefly touched upon, that today there are various judicial decisions which says that disallowance under 14A do not apply if you do not earn any exempt income. So if in a year your exempt income is zero, then there are certain judiciary precedents which says that you can't apply 49. So to kind of address some of these judicial precedent and to override it, the finance bill is proposing that you might earn zero exempt income in a particular year, and yet you have to, kind of apply the disallowance under section 49. The other issue is under 43 capital B. As you are aware that if you are making an interest payment to an NBFC, to a bank, or to any specified financial institution, you get a deduction of that interest only on actual payment. There were cases where such interest payable to some of these institutions were converted into some kind of, let's say, a debenture, some kind of a security. And the taxpayer used to argue that when I convert this interest into a debenture, it should be regarded as a constructive payment. If I convert this interest into shares, it should be regarded as a constructive payment. And therefore, a conversion of interest into such securities should make my claim of deduction tenable. And there were some judicial precedents supporting it. The finance bill is now saying, sorry, merely by converting your outstanding interest into some kind of a security, you have not discharged your liability to pay, and therefore such a conversion would not make you eligible to take a deduction under section 43 capital B. It's a bit harsh, but on a lighter note, companies which are not able to make interest payment, they would hardly care about such deductions, because I'm presuming they would have significant losses around. Next 2 points very quickly. One was, deduction under section 35. There was some ambiguity, I would say, which was there because of the amendment in the previous year. Also, a circular was issued that there were certain research associations, universities, etc., which are covered under section 35. They have to file the statement of donations, which gives details of donors, etc. And basis the provision which stood and the circular, there was an impression that if there is a failure to file such details, then the recognition under section 35 might be taken away, from such research institutions, universities. I think the finance bill is now kind of clarifying that inadvertent error by saying that no, what we mean is that if you do not file such statements, then the deduction under 35 shall be disallowed to donors. And that would not necessarily impact, the recognition which is given under section 35 to some of these research associations, universities, etc., which I think is a welcome clarification. We have this very interesting amendment under section 37. As you are aware, any expenditure which has been incurred for an illegal purpose or for a purpose which is regarded as an offense is disallowed. As Saurabh rightly mentioned, you had this interesting issue that when a pharma company makes a payment to a donor, which is not, let's say, permitted under the MCI rules, Medical Council of India rules, like a doctor cannot accept, let's say, gifts for a pharma company. There were certain arguments made by the pharma company that giving a gift is not an offense for me as a donor, but accepting a gift is an offense for the concerned doctor. So you please go and proceed against the doctor, but I would kind of what you can say, I would claim it as a deduction. So the finance bill now has made changes under section 37. It says that if I incur an expenditure which involves giving a benefit to the other person where he cannot accept it under the laws, then it will be deemed that this is an expenditure for an unlawful purpose. So effectively, the argument which the pharma companies could have made that it is an offense for the doctors to accept, not for the pharma companies to give, I think no longer that argument will be tenable. There is also some kind of a clarificatory amendment saying that even if there is an expenditure which is unlawful, not just by the law in India, but by a law outside India, that also would be covered under this rigors of 37 and it would not be allowed. So for example, let's say I incur an expenditure in USA, which under the laws of USA is an illegal expenditure. The tax officer can now even disallow that expenditure, irrespective of whether that expenditure could have been regarded as lawful in India or not. So in some sense, I would say the disallowance under section 37 pertaining to unlawful expenditure has been widened. Nothing more on this slide. Clearly there were some interesting decisions, including those of high courts, which says yes, you can go ahead and claim expenditure of an education cess, which obviously was always a big question mark. The government has now made an amendment retrospectively from assessment year 2005-2006, clarifying that sorry, this is part of tax, and you can't take income tax as a deduction. So I think this was expected sooner. One point on goodwill, we had a very funny provision introduced last year, which said that if your block of asset from a income tax depreciation perspective has any goodwill component, that you need to reverse that. And if the reversal of goodwill component into your block of asset, into your written down value, makes your block negative, then that negative would be regarded as a capital gain. And obviously there were rightfully an argument that a mere reversal, how can you deem it to be a capital gain? Because how can a reversal be treated as a transfer? They have now kind of tightened the provisions under the Income Tax Act, saying that such reversal will be deemed transfer, and therefore they in some sense are validating the rules which were issued last year, kind of taxing such a reversal which results in a negative block of asset. Of course, these scenarios will be far and few. I don't foresee this to have a very wide impact. Some other amendments, and we all know that Tata has recently taken over Air India. The question is, Air India would have significant losses under section, and whether once the ownership changes from a government to, let's say, a private company or a publicly held company like a Tata, is that something which impacts the carry forward of losses under section 79? And I think the government has brought this amendment under 79, clarifying that when an acquirer comes and takes over a public sector company, we will not disallow any carry forward of losses under section 79. But there are a couple of conditions. First condition is that the ultimate holding company, of the acquirer, they should ensure that directly or indirectly, they continue to hold 51% of the voting power of such a company, which they have acquired, Air India in our example. And the second condition is that if in any year you violate this condition, then the impact of 79 will be kind of affected in that concerned year. Of course, how it will get affected, that's a matter of debate. We will not touch it on this webinar, because let's say I am a private company, I take over a public sector company. Today 79 does not get hit. I get the benefit of these losses. After 5 years, I kind of sell it, change my ownership, but I've already consumed all the losses. So there is no loss which is there to reverse. So can really the government come back to say that, no, let me revisit all the losses which you have utilized in the last 5 years? Looks to be very difficult. The next amendment they have made is that, as you are aware, many startups are eligible for a recognition under 80 capital IAC. The process is you have to be first registered as a startup under DIPP. Thereafter, after getting yourself registered, you need to kind of apply to CBDT, and then they will pick and choose. Very few startups get a certificate under 80 IAC. But once you get a certificate, there are a host of benefits, including tax holidays, deferment of ESOP taxation, etc. One key condition is that such startups should be incorporated before 1st April 2022. So in some sense, we just had 2 months left for startups to be incorporated, to be eligible for such a benefit. So the government has rightly said, let's extend it by 1 more year. So now the startups have almost 14 months left to kind of form a company and kind of apply under 80 IAC for a recognition, which I think is on expected lines. One very important provision was about this new manufacturing tax of 15% under section 115 BAB. Again, one of the key condition was that you need to commence manufacturing latest by 31st March 23. So you just had, the coming year left. Now, COVID has really impacted a lot of capex plans. So obviously there were representations saying that you need to give more time for people to set up their plant and commence manufacturing. So the government has, gladly heard that representation, and now the time limit is 31st March 2024. So, corporates have 2 years to kind of set up a new manufacturing company, put up a new plant, and commence manufacturing. One dampener has been this, removal of taxation at 15% on foreign dividends. So if today I am a Indian company, I have a subsidiary, the subsidiary, foreign subsidiary declares dividend to me, I offer tax at 15% plus surcharge, which would be around 17%. But this particular section is going to be done away with from 1st April 2022, which means that from next financial year, if I as a company receive any foreign dividend, I would have to offer that to tax at 25% or whatever be my corporate tax rate. Which only means that if I'm planning some dividend, I have a timeline of 2 months. I better get my foreign dividends in the current financial year to take benefit of this 15%. But from next year, this benefit goes away. Of course, my deduction under ATM continues, which effectively means that if I'm getting a foreign dividend and I am distributing it back as a dividend to the ultimate shareholders, then I don't have to pay any tax because I will get deduction under ATM. So no impact on ATM, but where a company doesn't intend to declare a back-to-back dividend, they would obviously be taxed at a higher rate, which is 25%. I think one of the most interesting and one of the most mysterious provisions which the government has come up with is this ability to file an updated return. What is that provision? Let's jump into it. So they have introduced a new subsection 8A under 139. As you are aware, if I filed a return and I want to file a revised return, then I need to file that revised return, before 3 months of the end of the assessment year. Or before the assessment, whichever is earlier. Now, this provision says that I can file an updated return, even though the time limit for filing a revised return has gone by, within a period of 24 months after the end of the assessment year. And let us take some examples. Look at the current financial year, 2021-2022. My assessment year is basically the coming assessment year, and which is 22-23, and I can file this revised return up to March 2025. And the question is, why is the government allowing me to file an updated return, offering some income which I might have missed out in my original return or in my revised return? Is it a backdoor VDIS kind of a scheme? So that's an interesting question. Why is the government being so lenient? Of course, we'll come to it. There are some restrictions, but let us say I miss out on some income which I need to offer in the current year, and if I offer it within 12 months of the end of the assessment year, then I need to pay 25% additional tax on the tax which I've kind of missed out in my original return. Also this 25% of additional interest which I've missed out in my original return. Similarly, if I file my updated return not within 12 months from the end of the assessment year, but within 24 months from the end of the relevant assessment year, then I need to pay a penal tax of 50% on the tax and interest. And this additional 25% tax, this additional 50% tax effectively seems to be, like a VDIS additional tax, where the government will accept it and they will not, take any penal action, any prosecution against me. So it's a very interesting section. The government is going to come up with the relevant forms, detailed rules. So I'm sure more will be talked about this whole window of updated return. But there are certain scenarios where you cannot take advantage of this ability to file an updated return. Which are those scenarios? If you file an updated return and the updated return is a return of loss, you cannot take advantage of it. This is irrespective of the fact that your original return also was a loss return. So moment you file an updated return where even your loss might have been reduced, but sorry, it's a loss return, you cannot take advantage of this new window. Or if you are filing an updated return and it is resulting in a refund, or it is resulting in any kind of a decreased tax liability, sorry, you cannot file an updated return. If you have already filed an updated return, then you cannot replace it with a revised updated return. That's the second disqualification. And third is, if an assessment or a reassessment proceeding is ongoing or has been completed, you again cannot take advantage of this. So even if we view this facility as some kind of an ability to voluntarily disclose your undisclosed income or income which you might have genuinely missed out, moment an assessment or reassessment has started, sorry, you cannot take advantage of this. So before the tax officer proceeds, you have to go and kind of take advantage of this updated return window. There are certain other disqualifications. So for example, if there is a search and survey or raid carried out on you, then again you cannot, for that particular year for which a raid has happened, you cannot file an updated return. And you cannot file an updated return for even 2 assessment years preceding that assessment year. Again, if the assessing officer has received some information which it has communicated to the taxpayer that, hey, I've got this information that this income has not been disclosed by you or whatever it is, or any prosecution proceedings have been initiated for any of the assessment year, again for that assessment year you cannot file an updated return, which effectively means that as long as there is no proceedings on behalf of the tax office and you suddenly realize that this income has been missed out and my due date to file even a revised return has gone, you can take advantage of this window of filing an updated return. And obviously there is an additional tax of 25% and an additional tax of 50% depending on when are you going to file that. Very quickly on business reorganization and succession, there has been some interesting amendment made under section 170. What it effectively says is that if a company is under the process of a merger or under the process of a demerger, then any proceedings which have been initiated on the company which is getting merged or demerged during the pendency of this merger or a demerger shall be deemed to be on the new company. And why have the government brought this? Recently, there were certain cases, for example, Supreme Court case in Maruti and many other cases, where a company got merged into another company, but the assessment proceedings were initiated in the name of the old company. And the taxpayer interestingly argued that you have initiated assessment in the name of the old company, that company does not exist. So your whole initiation is void. Your whole initiation is liable to be cost, which the Supreme Court accepted. And it seems apparently that the government intends to address some of these scenarios to say that, yes, the old company may not subsist, may not exist. Legally, it might be liquidated. But if I've initiated certain proceedings, that proceedings should be legally be allowed to be continued in the name of the new entity. Of course, there are certain loopholes in that. We'll not touch upon that in this webinar today. But one interesting question is that while in the case of a merger, it is understood that A has extinguished and it has merged into B. So let's carry out the assessment in the hands of B. But how will the government do it in case of a demerger, where a unit of A has been demerged into B and A continues to exist? Why would it shift the assessment on B? And this seems to be a serious drafting error, which I hope they kind of rectify before the finance bill is legislated into a finance act, because it is practically impossible to shift income tax liability of A into B, especially where A continues to exist and run its other unit. The other amendment, which I would say a clarificatory amendment, which the government has made, there was this whole thing about IBC where under an IBC, even a tax office is kind of a creditor. And it is possible that under the IBC scheme of resolution, the tax office may not get anything or may get just part of its demand. You now have finally, and I think it's a welcome provision because it is clarifying this provision. You now have 156A, which says that when there is a IBC scheme which has, let's say, extinguished or reduced the tax liability, then the tax officer will pass a revised demand notice, either dropping that demand or coming up with that reduced demand. So this section is effectively an acceptance of the fact that an IBC resolution plan can eliminate or significantly reduce the tax liability, which the income tax officer would be bound to accept. So I think it's pretty good that such a provision has been brought in, because it is now, Income Tax Act has now been brought in sync with, I would say, the IBC provision. Let's look at certain anti-avoidance. The bonus tripping, which is so common. We have all seen bonus tripping happening on listed securities. Every January, February, we all wait for certain good stocks giving us bonus so that we can create certain capital loss, set it off against capital gains. So they have now tightened this bonus tripping, and they have brought this bonus tripping on securities under the ambit of 94(8), which already covered mutual fund units. Also, InvIT units, RIT units, AIFs are covered under bonus stripping and dividend stripping now. So, you will see going forward, it is almost impossible to carry out, dividend stripping and bonus stripping. I'll not touch upon section 68 much. Saurabh Bhai has very rightfully said that this whole unexplained cash credit has been widened. If I am, let's say, getting a loan or a borrowing, I now have the onus of even explaining the source of source. Now, how will that onus be discharged is anybody's guess. There is also a clarification that if there is any income which was undisclosed but which got kind of detected in the course of a search or a survey, then I will not be able to set off my carry forward loss or depreciation against that income. So it's kind of a penal provision, because in many cases people would say, okay, no problem, you have detected some income in some search or survey, but I have significant losses available, please set it off and no tax liability is due. But going forward, this stance may no longer be possible per se. Very quickly on TDS and TCS. So we all know we have this 194IA section. So where if I buy a property and I make a payment for that immobile property, then I as a buyer, I have to deduct TDS at 1%. They've made a minor amendment saying that this 1% is not just on purchase consideration. It is on purchase consideration or stamp duty value, whichever is higher. And obviously the threshold of 50 lakhs has been continued. There is no change in that. Which means as a buyer now, I have to be so conscious, am I buying this property at stamp duty value or at a lower value? The other TDS provision has been brought about under 194R. So what happens is if I receive any benefit or perquisite under section 28, then I am obviously supposed to pay tax on that. The government felt that, let's put the onus on the giver of such benefit or perquisite, so that this income is detected. So they have brought an obligation on the payer of such benefit or perquisite in the course of a business, where TDS at 10% will be deducted. So these amendments will take effect from July 2022. Very interestingly, you have this provision, where I, as a tax deductor, I have to be so conscious that have you filed your returns for the last 2 years? And if you have not filed your returns for the last 2 years, then the TDS rate increases to, I would believe, almost 5%? Yes. And the government has now said that, no, don't look at 2 years, look at 1 year. So in some sense, the government has kind of widened the coverage. So even if earlier I had filed a return for at least 1 year out of 2 years, this higher TDS of 5% would not have been applicable to me. But now instead of 2 years, they have made it 1 year. So it only means that you will have more people getting covered under this TDS section. And this amendment again starts from April 2022. Very quickly, I'll touch upon the miscellaneous provisions before I give the stage to Chintan to talk about GST and customs. IFSC, every year the government is making it more and more attractive. This year they have brought ship leasing activity to be part of the IFSC activity. So if I create a company, which is engaged in shipping business, and I make a payment to a foreign ship owner for the leases, there is no TDS required, no taxability. I, as a shipping business owner in IFSC, continue to enjoy the tax holidays, which are basically tax holidays for 10 years out of 15 years. If I transfer the ship tomorrow, any gain arising out of that transfer is eligible for tax holiday. And obviously, I need to start my shipping business in IFSC on or before 31st March 2024, which is 2 years later. So I think this is a great move. I have seen so many of my clients moving to Singapore, moving to Dubai to start shipping business. I think IFSC can now come as a credible option for them. Also, in respect of non-resident investors, I think last year they exempted transfer of certain forward contracts. This year they've added to that list. So now even any capital gain arising on offshore derivative instruments, over-the-counter derivative instruments, entered into with an offshore banking unit, that is going to be exempt. They've also clarified that if you're a foreign investor, your investment is being managed by a registered portfolio manager in IFSC, in an account maintained with, again, an offshore bank in IFSC, then to the extent these incomes do not accrue or arise in India, you will not be subject to pay tax. Because the fear was that if, let's say, via an IFSC portfolio manager, I have invested in, let's say, a US security, right? And the income is coming and getting credited directly to my banking account in IFSC. Can that be subject to tax? So I think this is a welcome clarification that no, the mere receipt in IFSC would not be subject to tax because this income outrightly has accrued outside India. You had this angel tax under section 56, which are not applicable to AIFs, but the way the law was worded, those AIFs are those category 1 and category 2 AIFs, which are registered with SEBI. But now you also have category 1 and 2 AIFs, which are registered not with SEBI, but with IFSC, which is the regulating authority in IFSC. So they've also brought that categories of AIFs into the ambit that angel tax cannot be levied for any investment received from these AIFs, which I think again is a very welcome clarification. Reassessment, I think this topic is just becoming more and more interesting. They have widened the ambit of what do you mean by income has escaped assessment. I think in some sense, I would say there was a debate happening that if a tax officer receives some information, let's say from some order of a court or a tribunal, can it be covered under information received by him? I would believe answer is yes, but there were some technical arguments, and I think the government is just being cautious, ensuring that the taxpayer does not get any argument. So in some sense, they have widened the source of information and they are covering it under section 148 and kind of giving more powers to the tax officer to initiate a reassessment. Last year, we also saw, the reassessment period getting increased to 10 years if the income which has escaped is above 50 lakhs. But this time they've clarified that it is not just income in the form of asset above 50 lakhs, which will get covered under this 10-year assessment reassessment period, but even an expenditure or a book entry involving income over 50 lakhs, which would get covered. And I think rightly they have kind of widened because they have realized that there could be there could be a scenario where there is no asset representing an escaped income, but there are certain unexplained book entries representing certain escaped income above 50 lakhs. So why not also bring that into the reassessment period of 10 years? So this is only giving more powers to the tax officer and going after the tax offenders. Faceless assessment, I think we will see a lot of procedural changes. In fact, they have substantially amended the faceless assessment section under the Income Tax Act. And what are the key changes? As Saurabh rightly mentioned, moment I as a taxpayer give a request for a personal hearing, it has to be mandatorily allowed. The tax officer has no choice, no option to say no. But yes, if I do not put a request, it will continue to be faceless. The second point which has happened is that there was a specific provision under the Income Tax Act which says that if the faceless assessment procedure is not followed, then the assessment will be regarded as void. And we have a couple of judicial precedents, coming in the last 1 year where certain high courts have said that the manner in which the faceless assessment was done, this makes the whole assessment proceedings void ab initio. Interestingly, they have deleted that consent provision retrospectively from 1st April 2021. So it needs to be seen what happens to some of these favorable cases which have come out. Can now the tax officer says that, yes, there was some lacuna in the procedure, but it does not necessarily make the assessment void. So one will have to wait and watch. And interestingly, the regional faceless assessment centers are done away with. So effectively, everything is being controlled centrally. So I do believe that they will come up with newer procedures on how faceless assessments are to be done. I think lastly on transfer pricing, just one important change that Section 263 gives a power to a commissioner or a PCC or a chief commissioner to kind of instruct a tax officer to do an enhancement if they believe that the order passed by the concerned tax officer is not in the interest of the revenue. Apparently, they realized that no such power are there with such commissioner to instruct a transfer pricing officer that your order is not in the interest of the revenue. So they have made that amendment, and now a commissioner can direct a transfer pricing officer under Section 263 that please revise your order because your order is not in the interest of the revenue. But are there parallel powers under 264 where I as a taxpayer can go and file an application to the commissioner saying that the order passed by the transfer pricing officer is prejudicial and not in accordance with law? Answer is no. You cannot do anything. That order will be kind of incorporated in the assessment order, and then I will challenge the assessment order. So obviously 263 has been amended in favor of a tax office, but 264 in the context of a transfer pricing order remains unchanged, and that option is not available to me. I think with this, we have kind of dissected the direct tax proposals. I would now invite Chintan to take over the GST and customs slide. Chintan, I can run the slides for you if you want.
Sure, Vishal. Is my voice echo? Hello. Vishal, I think I'll run the slides of this coach.
Sure, Chintan, you can load it.
Yeah, just a second. Is it visible? And I hope the voice is not echoing now.
No, it is not, Chintan. Please go ahead.
Thanks. Before discussing the key indirect tax proposal, it's interesting to note that there was no mention of any legislative changes proposed in the GST law as well as customs law in the finance minister's speech, except for some customs rate changes and the announcement that the gross collection made for January 22 is over 1,40,000 crores. Yes. Coming to the changes in GST law, there are some significant changes made in the input tax credit. A significant provision has been inserted regarding the ITC availment. The provision has been inserted to state that the ITC would be the ITC availment would be based on auto-generated statement, which we all know as GSTR2B. This GSTR2B will reflect ITC in two parts. One is where the ITC is eligible, and the other where the ITC is ineligible. The ineligible ITC would be reflected based on 6 scenarios. One is where the detail furnished within the prescribed period of taking registration. The other is where the supplier has defaulted in payment of GST and where such default has continued for a prescribed period. Third is where there is a mismatch in GST. Fourth is if there is an excess ITC availed. The fifth is if there is a default in payment of GST as per section 4912, which talks about maximum proportion of GST liability to be discharged through ITC, which we will deal in the later part of this PPT. And the sixth is the residual category, where it prescribes a class of person. If they have furnished the outward supply detail, then the recipient won't be able to take the ITC. Now, it is worth noting that this procedural aspect as well as the prescribed limit, which the finance bill talks about, would be notified later on. As of now, it is not available in the public domain. If one recalls, effective from 1st January, the ITC could be availed only if the amount 100% matches with the GSTR 2B. Now, with the above amendments, the ITC availment would become a more stringent process for the recipient. One more detrimental provision which has been incorporated is that if the supplier has not paid the GST, then the recipient is required to reverse that ITC along with interest. However, if the ITC so reversed is paid by the supplier, then the recipient could again avail the ITC. Interestingly, there is no provision or discussion about re-availment of the interest so paid earlier. So basically, whatever the interest is paid would be a cost to the SSE. The fundamental flaw of these provisions, which we just discussed, is that the recipient of the supplier is being chastised for the default or the non-compliance of the supplier. In reality, the recipient would have no control over the supplier's GST compliance. Now, one of the fundamental feature of GST was to have a seamless flow of input tax credit. However, if the above provisions really counteracts the whole concept of seamless flow of credit. Moving on to the next proposal, a retrospective provision has been proposed, which states that the interest liability would arise only when the ITC is wrongly availed and utilized, and the interest rate would be 18%. Since the inception of GST, a controversy was prevalent whether the interest liability would arise only if a person wrongly avails the ITC, or it would arise when the ITC is wrongly availed and utilized. Now, because of this amendment, this controversy would be resolved. This amendment is retrospective in nature, hence a beneficial provision. Coming to some of the procedural aspects, a beneficial amendment has been proposed with regard to the time limit for availing the ITC, as well as the time limit for issuing the credit note, along with the rectifications of error in GSTR 1, if any. The previous time limit was the due date of filing GSTR 3B for September subsequent to the financial year. Now this time limit has been revised to 30th November of the subsequent financial year. So this amendment effectively gives 8 months to the SSE to make a revision in the credit notes or avail the missed out ITC instead of the previous time availability of 6 months. The next two amendments are related to period-wise sequential filing of the returns. Henceforth, the monthly GSTR 3B return for a particular month would not be allowed to be filed unless the GSTR 1 of that particular month as well as or the GSTR 3B of previous months are not filed. Similarly, GSTR 1 for a tax period would not be allowed to be filed if GSTR 1 for previous tax periods is not filed. And of course, there would be some exceptions to this rule, which are yet to be notified. A benefit coming to the next proposal, a beneficial provision has been incorporated, which allows the amount lying in the electronic cash ledger of a registered person to be transferred to the electronic cash ledger of a distinct person. In other words, to give an example, if let's say if there is substantial amount of cash lying in the electronic cash ledger in the Gujarat registration, that amount can be transferred to, let's say, a Maharashtra registration. Presently, there was no such provision, and one had to go for a refund of such excess cash lying in the cash ledger. With this provision, the compliance hassles of obtaining refund would be resolved by this. The next provision, which is section 49(12), talks about prescribing the maximum proportion of output GST liability which could be discharged through electronic credit ledger. Now, if you are aware, this provision is already under GST law in the form of Rule 86B of the GST rules, which talks about that 90% of the GST liability could be discharged through ITC and balance is to be discharged through cash. Needless to say, this provision is applicable only to certain specified category of people who qualify the criteria later. Apparently, this provision seems to have been incorporated to back up the Rule 86B, which is existing in the GST rules. Moving to next proposal, certain provisions in the Act like Section 42, 43A, etc. Are being omitted, which are essentially for matching, reversal, reclaiming of ITC, invoice acceptance mechanism, etc. These are nothing but the GSTR 2 and GSTR 3, which were initially introduced but now are defunct. The next provision is about notifying the relevant date for supplies made to SEZ and SEZ unit and developer. Now, under GST law, a refund is being provided if you are supplying goods or services to SEZ units or SEZ developer. And such refund is required to be claimed within 2 years of the relevant date. Now, there is an ambiguity as to what exactly is the relevant date when I supply goods or services to SEZ unit or developer. To remove this ambiguity, they have inserted the provision which states that the relevant date for such kind of supplies would be the due date of filing GSTR 3B. Coming to legislative changes in the customs, an important amendment has been made on the adjudication aspect of the customs law. To understand this, one must refer to the Supreme Court ruling in the case of Canon India. In this case, in the case of Canon India, the Directorate of Revenue Intelligence, that is DRI, had initiated duty recovery proceedings against Canon. The matter was litigated and reached to Supreme Court, and the question before the Supreme Court was whether DRI is empowered or authorized to initiate such kind of recovery proceeding. The Supreme Court held that the DRI officer is not the proper officer under the Customs Act as defined under the Customs Act, and hence such proceedings are illegal and void ab initio. The court also established a principle that where one tax officer has exercised his power of assessment, the power to order reassessment must also be exercised by the same officer and not by any other officer of another department, though he is designated as an officer of the same rank. Because of this ruling, several proceedings which were initiated by the DRI became invalid. The assessors started getting favorable order from the high courts, from tribunal due to this Supreme Court ruling. And thus the SCN which were issued by DRI were getting quashed across the country. Now, to overrule the Supreme Court rulings, the amendments have been proposed in the Custom Act to say that the officer of DRI, the audit officer, and the preventive officer would be considered as a proper officer under the customs, who would be authorized to issue such show cause notices and initiate the proceeding. Also, the power of assignment of function to officers has now been vested with CBIC as well as the Commissioner or Principal Commissioner of Customs. Most importantly, this amendments and the validation has been provided retrospectively, which essentially makes or nullifies the Supreme Court ruling. The next proposal is on the advanced ruling. It states that the advanced ruling now obtained under the Customs Act would be valid for a period of 3 years if there are no changes in the facts or the law. Presently, this advanced ruling would have been perpetually valid if there are no changes in the facts of the case or the law. But with this provision, the validity would be restricted to 3 years. The next proposal is about punishing a person who would publish information relating to valuation, classification, and quantity of goods for import or export, or who publishes the details of exporter or importer. This has now been made a punishable offense, which attracts imprisonment up to 6 months or a fine of rupees 50,000 or both. An exception to this provision is that if the information is published as required under any law, or it is published by or on behalf of central government, then it would not be considered as an offense. The next point is regarding the CBIC is now enabled to specify additional obligation on the importer in respect of specified class of imported good whose value is not declared correctly in the bill of entry. And also the CBIC is now empowered to issue the criteria for selection of such goods for scrutiny. This amendment has been made as a measure to address the undervaluation in the import of goods. A new section, section 110 AA, has been introduced to specify that post completion of any kind of investigation or audit by any officer, such officer has to transfer all the documents and information to the original jurisdictional authority, and the original jurisdictional authority would only be able to assess the tax liability. This is done again with to comply with the principle established by Supreme Court in Canon India. The next provision, next change is about changes in the IGCR rules. An importer who is availing the benefit of concessional rate of duty is required to comply with these rules. Through this budget, the rules are being amended to simplify, automate, and digitize the whole process. A welcome clarification has been issued regarding the leviability of social welfare surcharge, or as we call it, SWS. Typically, SWS is levied at the rate of 10% on the aggregate value of the customs duty. Now, let's say if the custom duties are exempted or they are zero, then logically the SWS should also be zero. But various customs authorities have been taking a view that social welfare surcharge would be payable on notional customs duty, even if the basic customs duty, etc., have been exempted. This circular, the circular has been issued, which now clarifies that SWS would be nil in such circumstances. This clarification would help in providing a closure to various kind of inquiries being undertaken by the customs authority. Coming to custom rate changes, in the last two budgets, several customs exemption have been rationalized, and continuing the trend, more than 350 exemption entries are proposed to be gradually phased out. Furthermore, after a detailed review of the custom duty exemption on capital goods and project import, around 40 exemption are proposed to be gradually phased out. The custom tariff structure is also being simplified by moving the unconditional concession rates from existing exemption notification to the tariff. And as a part of the rate revision exercise, the government has proposed to amend the levy of social welfare surcharge on various items. Also, a graded import duty structure is being notified to operationalize the phase manufacturing plan for wearable, hearables, and smart meters, where the custom duty would be increased in a phased manner in the coming years. Coming to the last part of this presentation is on the SEZ reforms. The budget speech has mentioned that the SEZ Act will be replaced with a new legislation that will enable the states to become partners in development of enterprise and service hub. Basically, the objective over here is to convert SEZs from having focus only on export to having a focus on industrial development and service sector development. It needs to be seen how this plays out once the legislation is out. It is also proposed that the customs administration of the SEZ would be fully IT driven, and the risk-based check or the assessment would be made on a sample basis only. This reform shall be implemented by 30th September of this calendar year. So these were some of the important indirect tax proposals from in the budget 2022, and we can expect the notifications and circular to implement this proposal once the provisions are made live. That would be all from my end.
Thanks, Chintan. Chintan, you can unshare your screen. So I think we have come to the last leg of our webinar, and if there are any Q&As, do put it on the Q&A box. We'll take it up one by one. Saurabh, thanks a lot. Glad to see you. You were right till the end. Saurabh, any critical comment you want to make on any aspect?
No, I don't think that anything is likely to really create so much of confusion that it requires to be addressed. Honorable Finance Minister has clarified some issues, added some items for tax, given some benefit. It is sprinkling little here, sprinkling little there, but there is no fundamental change in the approach, which would require, in a way, more critical examination. That's how I will put it.
I think with that, what we'll do, we'll take up, there are some few questions, and the first question is from Jayesh Bhai. The question is, if one invests in a crypto ETF or a company whose main assets are crypto, the new tax regime of 30% will not apply. Similarly, if crypto is held through an offshore company or even personal investment company, then whether this 30% will apply. And Jayesh Bhai, you are absolutely right. Because here you are investing in either a company or a fund like a ETF, which is then holding crypto. In that case, there should not be this taxability of 30%, because it's that underlying fund or the company which is holding crypto. So completely agree that the 30% tax rate should not apply. The next question is, what to do if you have already claimed an education cess as a deduction? Should we file revised return if possible? And I think it's given that, if you've already claimed education cess, in the assessment, it is likely to be disallowed. So answer is yes, you'll have to kind of recompute your tax. And if you're able to file a revised return, you file a revised return with an appropriate covering letter that this is a change of law, and I am now kind of recomputing my tax and appropriately paying the taxes. So yes, if it's possible, you may do it. If it's not possible, you might still recompute the tax and kind of pay it under a white paper covering letter. So it will depend on facts to facts, where you are in that assessment order. But yes, the education cess is now be bound to be disallowed if your assessments are still pending. The next question is, I think Ashok Bhai is asking, virtual digital asset, under which head it would be taxed? If I'm buying and selling them, will it be business income? I think in one sense, it won't matter, as Saurabh Bhai mentioned in his opening remark, that it's a separate tax rate now which has come. Now, whether you offer it under the business head, you offer it under the capital gain, it's not going to change your computation, because you are really applying this specific tax rate of 30%. So in my personal view is it was more akin to a capital asset, unless you are said to be in the business of it. So you would have typically applied the badges of trade test, what we apply to normal securities, to determine whether you are into the business of buying and selling securities or it's an investment asset for you per se. But it fundamentally does not make any difference to your tax computation per se. The next question is whether basic exemption limit will be available to assessee in virtual asset. Very, very interesting question. And it seems that you will not get the basic exemption limit. It's a special tax. Also, if you look at, Part C of the Finance Act, which is computing the advanced tax, they are specifically excluding this section of 30% from the slab benefits. So it's unlikely that you will get any basic exemption, any slab, which theoretically means even if you earn 1,000 rupee and you have no other income, you might have to file a return offering 30% of tax thereon. The next question is, yes, would we share the presentation? Yes, we will be emailing this presentation to all the participants by tomorrow. So that's not an issue. The next question is the NPS contribution limit increase applicable to private sector employees? No. What they have done is they've brought parity between the state government employees and the central government employees. So this is not, the enhancement is not applicable to private sector employees. The next question is relating to amendment under section 149 1B. This is a question, Saurabh, for you. Proposed amendment under section 149 clause 1 subclause B doesn't contain the words for that year. Is there any significance to that?
To my mind, no, because 149 1B is giving power to reopen beyond a period of 3 years in relation to relevant assessment year. And now the power is given not only if an asset is found, but also an expenditure or entry is found. But that in any case has to be in relation to relevant assessment year. Meaning thereby, if it is found that there is an unexplained expenditure 5 years back, there is a marriage in the family, and it is found that yes, rupees 1 crore were spent, which is not disclosed in the books of account, the assessment of that year will be reopened beyond a period of 3 years. But I don't think that absence of the words for that year give a license to the revenue to go straightway from 3 to 10 in relation to every year. That does not appear to be the intention.
Thank you, Saurabh. We have one question from Mr. Manoj Solanki, who says whether this provision of explaining source of source from even a borrowing will apply if the borrowing is from a non-resident. It seems it applies, Saurabh. I don't think there are any exceptions. Any way to come out of it doesn't seem. The provisions are pretty wide enough to cover it. Any thoughts, Saurabh, on that? Sure. Okay, I'll go to the next question. It says, this is a question from Vishal Santani, whether this update return for financial year 2021 as due date are written till March this year, so no time or little time for revised return. I have not exactly got the question, but your question is, can I in future file an update return for financial year 2021? Answer is yes, absolutely. That is possible. So if you're not able to file a revised return for financial year 2021, clearly you will be able to file an update return once the forms etc. are notified. So that should be possible. We do not have any further questions. So I think with that, okay, we have one more question coming. Can updated return be filed if 143(1) intimation is issued? I think prima facie, the section talks about assessment or reassessment. I think it's talking about assessment or reassessment or recomputation or revision of income under that act is pending or completed, and 143(1)(a) might neither be an assessment or a reassessment. Prima facie, it seems, while one would need to study in detail, it seems an intimation may not necessarily prohibit you from filing an updated return. The next question is, if I've invested in crypto, will I be able to net off the losses in the current financial year 21-22? Yes, this law is applicable from next year. So you can do whatever you want for the current financial year. Right. Sorry, there is one last question for you, which says that there is this new insertion of 149(1)(a). Was this section at all needed?
149(1)(a).
149 subsection 1(a).
No, amendment is only in 1B. There is no 1A amendment. B is sought to be substituted. Clause A is, oh, 1 capital A. Okay.
Yes, 1 capital A. Yeah.
Okay. In fact, 1A is also answers partly the other issue. Suppose it is found that there is a marriage expenditure of 60 lakh. I said that the case will be reopened only of the year in which there is an expenditure of rupees 60 lakh, neither earlier year nor later year. 1A now clarifies this. 1A says that let us say rupees 60 lakh is spread over 2 years. 40 lakh in year 1, 20 lakh in year 2. No year individually will cross rupees 50 lakh. And therefore, SSC could have argued that because it does not cross 50 lakh, you can't reopen any of the years. 1 capital A seeks to clarify that if the undisclosed asset or expenditure is in relation to an item or an event which is spread over for more than 1 year, and collectively it is more than rupees 50 lakh, then revenue will have a right to reopen assessment of both or all the years, though individually income escaping assessment might not in the respective year exceed rupees 50 lakh. Therefore, I had not noticed 1A earlier, and therefore I said on first principle they will reopen only that year. Now 1A makes it very clear they will reopen only that year or those years where the income in excess of rupees 50 lakh is escaped assessment and in relation to a particular activity or expenditure.
I think with this we have taken up all the questions. So it's time to conclude our today's webinar. I would like to thank Saurabh bhai once again for being there, gracing the occasion and sharing Saurabh bhai your wisdom with us. Thanks a lot. Thank you once again to all the participants for attending, and we will be sharing a copy of this presentation and a copy of this webinar. Hopefully we'll put it on YouTube for a limited period of time. So with that, we would consider this webinar to be concluded. Thanks a lot, and good night to all of you. Thank you, Saurabh bhai.
Thank
Thanks
you.
a lot.
Thank you, Saurabh bhai. Thanks.
Thank you.
Bye.